Good morning, everyone, and welcome to our Budget Question Time webinar. I'm Jennifer Williamson, a partner at Creston Reeves, and I will be chairing our session today. Can I just start by saying how delighted we are to have so many of you join us this morning. So just a little bit about Creston Reeves before we dive into the budget detail. So for those of you who don't know us, we are much more than just accountants and wealth advisors. We're really proud to work alongside our clients to help them achieve their ambitions, both in the UK and internationally through our Creston network. Now, there were no rabbits out of the hat on Wednesday, with many of the changes being pre-announced. But what was clear was that Jeremy Hunt wanted his first budget to be simple, stable, and to portray calm and competence. Because after a particularly turbulent time for government, Wednesday's budget returned to more familiar territory as Jeremy Hunt looked to restore the Conservative Party's reputation for fiscal management. It was, he apparently told his backbench MPs, a budget to win the next election. But what might ask, does the Chancellor's budget mean for those of us outside of Parliament? What impact will Wednesday's budget have on business and individuals? The Chancellor said that this was a budget for growth, and it certainly had no lack of ambition as he outlined 4 pillars to support growth: enterprise, employment, education, and, well, everywhere. But in trying to be everything for everyone, has he fallen short or come up trumps? Now, there were certainly some big numbers and measures with wide-ranging implications, from increases in free childcare and full expensing for capital expenditure, to significant increases in the pension annual allowance and the scrapping of the lifetime allowance. It will, of course, take some time to see if these changes deliver the outcomes the Chancellor is looking to achieve. So let's take a look at the newspapers and some of the top headlines since Wednesday to give a flavour of the wider reaction to the measures that have been announced. So the Mirror went with pots for the rich, highlighting the 3.8 billion pension gift to the wealthy, but being critical of the lack of support for public sector workers. The Times ran with a similar theme, giveaway for the 1%, referring to the huge pensions giveaway for the wealthiest 1% in an attempt to help stem the tide of people leaving the workforce. The Independent ran with stealth 4p rise in income tax, and here they're highlighting that the freeze to income tax thresholds at which people start paying basic rate, higher rate or additional rates of tax is estimated to affect approximately 6 million people and will raise 29.3 billion a year for the Treasury. The Sun ran with childcare jackpot, highlighting the major plans for the parents of 1- and 2-year-olds who for the first time ever will get 30 hours of free childcare a week in the future. The Chancellor is also expected to hike the hourly rate paid by the government to childcare providers who have long said that the help they get doesn't actually cover their costs. And more wraparound childcare through schools is also expected to be announced. And the Telegraph ran with tax burden to hit highest levels since Second World War, and they're referring to the OBR predictions that households will face the biggest 2-year squeeze in living standards on record, and that the increase in corporation tax rates from next month will push corporation tax receipts as a share of the economy to the highest level since the tax was introduced in 1965. And of course, it would be remiss not to mention the plans to freeze duty on both beer and fuel, as well as the government's stated aim to fix 4 million potholes, and perhaps that's their own version of levelling up. So we'll be spending the next hour talking you through the key tax and financial planning implications of the budget for both businesses and individuals. And we'll then move into a Q&A to answer any questions you may have. So I'd like to introduce now our panel of experts who will shortly be appearing on screen. We have Daniel Grange, our Head of Tax, Sam Jones, our Corporate Tax Director, and Kim Williams, our Financial Planning Director. If I can just start with some housekeeping, I would advise everyone that this webinar is being recorded and a recording will be sent to you all later in the day. And IT permitting today, we will be asking you for a bit of interaction by taking some polls throughout the presentations, and we'll be sharing the results from those polls with you when we send you a copy of the webinar recording. You'll see our hashtag budget question time at the bottom of our slides. Please do keep an eye out for further information on the budget announcements and more insights from us as more detail becomes available by looking out for this hashtag on your social media channels. And there will also be a pop-up survey at the end of our session today, and we'd be really grateful if you could spare just a couple of minutes to provide us with some feedback. And finally, for the questions you do have, we've had some pre-submitted, but if you have any as we run through the presentations, please submit your questions via the questions box at any stage throughout the webinar. On screen now, you'll see some instructions for how to raise a question, which we'll leave there briefly whilst you familiarise yourself with that function. Wonderful. Well, we'll say goodbye to our panel of experts for now until the Q&A session later, and I will pass you over to Daniel Grange, who will be running through the top personal tax implications.
Thank you, Jennifer, and good morning, everybody. As Jen said, I'm going to run through the key tax implications for individuals coming out of this week's budget. But before covering this week's budget, I think it's worthwhile reminding ourselves of some of the announcements made last autumn that will have effect from the 6th of April this year. There was so much coming and going last autumn, it's difficult to keep track of all the changes that were announced and what's really coming into force. So the changes that were announced last year are really around income tax rates and thresholds. And these have, in the main, been frozen. And this means, particularly with inflation and higher incomes, that more people will be brought into the income tax net and be taxed at higher rates. So the personal tax-free allowance has been frozen at just over £12,500. And I think it's worth remembering that this is withdrawn at the rate of £1 for every £2 of income that you have over £100,000. And because of the way this works, this gives an effective tax rate of 60% on income between £100,000 and just over £125,000. So that's not a published tax rate, but because of the interaction between the higher rate of tax of 40% and the withdrawal of that personal allowance, that income is taxed at an effective rate of 60%. And if you're in this tax bracket, it's really worth considering some planning opportunities, such as making personal pension contributions that we'll talk about a lot more later, and also making charitable donations. They can then benefit from tax relief at this effective 60% rate of tax. So the top rate of tax, the additional rate, is currently payable on taxable income of more than £150,000. And that threshold is reducing to just over £125,000 from the 6th of April. So that will mean that more people will be subject to this additional, the very top rate of tax, which, as you can see on the slide, is 45% on employment, self-employment, rental and savings income, and is 39.35% on dividends. If you do receive dividends, do remember that the tax-free dividend allowance is reducing from the current £2,000 a year to just £1,000 a year from the 6th of April 2023. On capital gains tax, despite lots of speculation last autumn, there were no changes to the rates of tax or the reliefs available, but the tax-free annual exemption is being reduced from the current £12,300 to just £6,000 for next tax year. So now turning to the changes that were announced on Wednesday. There weren't that many announcements made affecting individuals, but the few changes announced really are quite significant, and the major changes relate to the tax treatment of pensions. I think at this stage it's worth remembering that you can get tax relief on contributions that you make into pensions, whether that's personally or by a company. The funds grow income tax and capital gains tax free, and the value is generally not subject to inheritance tax on your death. So pensions are an incredibly tax efficient wrapper. So the first change to the pension tax treatment of pensions is to the annual allowance. And this is the amount that can be contributed to your pension fund each tax year without incurring a tax charge. And you need to remember that this looks at the total amount contributed to the pension fund, both in the form of personal contributions and employer contributions. And it also includes any tax relief the pension fund claims at source on those personal contributions you make. If you have a defined benefit scheme, so final salary scheme, the rules for calculating the amount of contribution is quite complex. So you need to look at that in particular detail if you're lucky enough to still be a member of one of those schemes. And if more than the annual allowance is contributed, the excess is subject to income tax at your marginal rate of tax. So this could mean that you have a personal tax charge even if you've not had any personal tax relief on the pension contributions that you've made. And this will be the case if your employer contributes more than the annual allowance to your pension. It's also worth remembering that you can use unused allowances from the 3 previous tax years. So I'd recommend that you review your pension contributions over the past 4 years, including the current one, to see what unused allowances you have available. And do remember that personal contributions are limited to an individual's net relevant earnings in a tax year. And that's broadly employment income and self-employment income, but doesn't include investment or rental income. But that limit does not apply to employer contributions. So moving on to the annual allowance itself, the current standard annual allowance is currently £40,000. And with effect from the 6th of April 2023, this standard allowance will increase to £60,000. The allowance is reduced or tapered where you're a high earner, and the way in which that taper applies is also changing. So under the current rules, the taper starts to apply if you have income of more than £240,000, and there's a minimum allowance of £4,000, which applies if your income is more than £312,000. From the 6th of April, the taper will apply if your income is more than £260,000. So there's a £20,000 increase in the income you can have before the taper starts, and the minimum allowance will increase from £4,000 to £10,000 a year. And that £10,000 allowance will apply if your income is more than £360,000. So I think it's really helpful to show the impact of these changes by way of quite a simple example. So in this example, we have an individual who has income of £300,000 in both the current 2022-23 tax year and the next tax year, when the new rules will apply. Could we move on to the next slide, please? In the current year, the standard allowance is £40,000, and this is reduced by £30,000 on the taper because of this individual's income being more than £240,000. They have an annual allowance of £10,000 for the current tax year. For the same individual next year, the starting allowance increases to £60,000 and the restriction reduces to £20,000. And that means that they can contribute up to £40,000 to their pension fund next tax year with no other changes to their circumstances. So they can contribute an additional £30,000 to their pension fund compared to this tax year. With this tax relief, this £30,000 additional contribution will cost them £16,500 if they make a personal contribution. So as you can see, the change that was announced on Wednesday could have a really significant impact for some individuals. The second change to pensions that was announced was to the lifetime allowance. And the lifetime allowance is the maximum value of your pension fund that you can have before you pay a lifetime allowance charge on something called a benefits crystallisation event, which is when you start to take benefits from your pension fund, turning 75 or on death. The current standard limit is just over £1.07 million, having been as high as £1.8 million in the past. The lifetime allowance charge is charged at a rate of 55% on the excess over that lifetime allowance, where you take the excess as a lump sum, and as an additional 25% on top of your normal income tax charge when you take it as a pension. And you may have enhanced, fixed or individual protection in place, which means that your lifetime allowance is a different figure. And Kim is going to talk about how these changes affect those protections later on. The announcement on Wednesday was that these lifetime allowance charges will be removed with effect from the 6th of April, and the lifetime allowance itself will be abolished from April 2024. As I mentioned earlier, pension funds are generally outside of your estate for inheritance tax purposes, so they can be left to beneficiaries with no inheritance tax and stay in that tax-free pension environment. Tax generally only bites when those funds are withdrawn from the pension. And if the individual died when they were under 75, those funds can be extracted with no tax at all. Even before these changes were announced, we were seeing clients use pension funds as an estate planning vehicle, but there was an effective cap of just over £1 million. We think that this change will see more people using their pension funds as an estate planning structure. So placing assets in the fund that can grow tax-free, be available to them should the need arise, but also allow those funds to pass to future generations without an inheritance tax charge. And this type of planning could be combined with using assets that are subject to inheritance tax, such as savings and investments to fund lifestyles, rather than withdrawing funds from a pension in the form of an income. This could further reduce the potential inheritance tax exposure. The ability to access funds that are outside of your estate is not generally available. There are lots of anti-avoidance rules to stop that. So this is a great tax planning opportunity. And this is in addition to the tax relief on pension contributions and the funds growing income and capital gains tax-free. I think it's important to note we've only had the headlines from the budget on Wednesday, and we'll need to wait for the legislation to see how the changes will be applied and whether there'll be any restrictions that were not covered in the initial budget paperwork. So before I hand back to Jennifer, we'd really like to get your views on the announcements that were made. So we'd be interested to know whether you think the increase in the pension annual allowance will mean that you will contribute more to your pension. And whilst you're thinking about that, I will hand back to Jennifer. Thank you.
Thank you very much, Dan. So as I mentioned, those answers to those poll questions will be sent to you along with a copy of the recording when we finish. So some really big changes there to the pension rules, and some of you may be keen to understand the financial planning opportunities this may open up for you. So next we'll be hearing from Kim Williams. Over to you, Kim.
Thank you, Jennifer, and good morning to everyone. So thank you, Dan, for covering most of the pension stuff, which is really useful. So as Daniel said, I'm just going to concentrate more so on the lifetime allowance side of things, which I think was a bit of a shock to everyone. But so we have seen the biggest change to pensions in almost 10 years when the pension freedoms were introduced. So just to recap, the lifetime allowance is the maximum value you can save into a pension before tax of up to 55% is paid on any excess above that 1.07 million figure, that standard figure. Your tax-free cash has always been limited to 25% of that value, which, as Daniel said, is the 268,275 figure, and that remains in place. But as an example, if your fund value is 1.5 million, and you have no HMRC protection in place, you can access around 17% of your fund tax-free. So there is always been a restriction on that 25%. The lifetime allowance was introduced back in 2006, and back then it was 1.8 million. It's since been reduced over the years. If you met certain criteria, you were able to protect your pension funds from these changes by applying for HMRC protection. The most commonly known are individual protection and fixed protection. If you have these protections in place, your tax-free cash would be 25% of that protected value. So that is higher than that standard 268,275 figure. Again, that remains in place. The rules of fixed protection mean that you're unable to add more funds into your pension fund. So now that the lifetime allowance has been abolished, you could argue that this no longer applies. However, if you revoke your fixed protection by making further contributions now or from the 6th of April, these current rules state that you must let HMRC know within 90 days to avoid a fine. We don't know yet if these fines will remain in place. We don't know whether we need to let HMRC know if we decide to make contributions under fixed protection. If you've drawn your tax-free cash already and you have that fixed protection, you could argue that you've taken the maximum allowable tax-free cash anyway. But there has been some noise around Labour saying that if they are elected, then they could reintroduce the lifetime allowance. So future changes in pension legislation is always something to be aware of. Under the other form of protection, so individual protection, the rules state that you can continue to pay into your pension fund and you won't revoke that. So that's different to the fixed protection rule. However, your tax-free cash is limited to 25% of your individual protection. So if you add further monies into your pension and you've got individual protection, you may not receive tax-free money on future contributions. Making payments into your pension so largely depends on your personal needs and objectives. So if the driver is inheritance tax planning and you're not concerned about your tax-free cash or any changes in future pension legislation, then saving into pensions for you could work well. However, we would always suggest that you speak to your financial advisor beforehand. I will add, all of these changes are of course subject to the finance bill. So I think the message for now is to tread with caution until the finer detail of how removal of the lifetime allowance works with any HMRC historic protections that you have. So before I hand back to Jennifer, I would like to get your views on the announcements made as well. I'd be interested to know if the main driver for you saving into pensions is to allow you to pass your wealth onto the next generation free from inheritance tax. Thank you very much.
Thank you very much, Kim. For those of you online, you might have noticed we have a slight delay with some of our slides coming up. Apologies for that. Technology is always there to cause us a bit of an issue. But just to reassure you, we'll be getting copies of all these slides when a recording comes out to you later today. So once you've had an opportunity to answer that poll question on screen now, I will hand you over to our final panelist, Sam Jones, to run through the top implications for business. Over to you, Sam.
Thank you for the introduction, Jen. Just wait for the slide to come through. So today I'm going to run through the main changes that are going to be impacting businesses. As previously mentioned, there weren't any big surprises for businesses in the budget. Most of the changes that will impact businesses had already been previously announced and will mainly impact companies as opposed to unincorporated businesses. The biggest change that will impact companies from April 2023 is the increase in the corporation tax rate to 25%. Even though there will be a 6% hike in the corporation tax rate, Jeremy Hunt has stated that the 25% rate is still the lowest of the G7 countries, continuing to make the UK a competitive place for business. We have had a single rate of corporation tax of 19% for the past 6 years, which has applied no matter the level of a company's taxable profits. Not all companies will pay the full 25% tax rate. Companies with profits of £50,000 or less will continue to be taxed at 19%. but the new 25% rate will apply for those with profits above £250,000, which will impact just 10% of companies according to the Chancellor. Please note that these profit thresholds are reduced based on the number of associated companies, which are generally group companies and companies under common control. Where a company has profits between the thresholds of £50,000 and £250,000, the marginal rate of tax will be used to bring the average tax rate up to 25%, the nearer the profit figure is to the 250k threshold. In practice, this means that profits between 50,000 and 250 will be taxed at a marginal rate of 26.5%. If profits do fall into this bracket, careful consideration should be given to how to mitigate this liability. We knew that the 130% super deduction was a 2-year measure to encourage businesses to invest in capital expenditure, and that this was due to end on 31st March. The Chancellor acknowledged that the removal of this relief would impact on the tax competitiveness of the UK, and therefore has introduced full expense relief for capital expenditure up to March 2026. This relief will allow companies to deduct their capital expenditure in full against taxable profits on the acquisition of new and unused plant and machinery. As with the super deduction, this expense relief is only available to companies and not unincorporated businesses. Many may think this is in fact a reduction to the relief provided under the super deduction. However, when you run the numbers, the tax saving of the 130% super deduction at today's 19% tax rate compared to a full 100% relief at 25%, the tax saving is in fact very similar. In addition to the full expensing relief, the 50% first-year allowance for spend on special rate assets will also be expended until March 2026. Sitting back and considering these changes, majority of businesses already obtain full deduction for capital expenditure they incur on the same assets via the annual investment allowance. It was also previously announced that the annual allowance will remain permanently at £1 million. Therefore, very few businesses will obtain additional tax savings. So there are a couple of areas in which companies can reduce the impact of the rising corporation tax rates, especially those companies who are in the effective marginal tax rate of 26.5%. The utilisation of any tax losses in groups could be one way, ensuring losses are allocated firstly to any marginal rate companies. Alternatively, we can consider whether utilising losses in the current 19% tax period, or whether to carry these forward to when the tax rates are higher. We've already heard the annual allowance for pension contributions is due to increase. Employer pension contributions are tax deductible for corporation tax purposes. Therefore, the increase of the pension annual allowance from £40,000 to £60,000 per annum could allow companies to review the remuneration planning to reduce their taxable profits, and therefore the impact of the rising corporation tax rate. Companies will also be able to obtain full relief for capital spend, as we've already mentioned, to reduce their taxable profits through either the use of the £1 million annual investment allowance or full expensing relief. The tax thresholds are reduced by the number of associated companies. Therefore, groups could consider reviewing their group structure to minimise the number of group companies. This could be by closing down small or negligible trades, or consider consolidating companies. Given the volume of changes on R&D, I thought it would be helpful to recap where we are on the next slide. R&D has been a hot topic for the past year or so. There have been so many changes relating to relief that have been announced. The government remains committed to driving innovation and growth within the UK economy with the use of R&D tax credits, but it is felt that this has to be balanced with perceived misuse of the relief, particularly the very generous SME scheme, where spurious or worse fraudulent claims are being made. I've included a link to a recent article which details all the changes that were previously announced. Many will have seen or will shortly see a reduction in the tax benefit of the relief. Many changes already announced aim to focus the relief on UK-centric spend. This will impact companies who contract aspects of their R&D projects overseas. This may be to utilise the expertise of workers, or where the cost to subcontract outside the UK is potentially cheaper. However, these overseas activities do not always meet the government's objective to drive innovation in the UK. This week's budget did push back the implementation of the exclusion of overseas spend to 2024, which will provide some breathing space to those affected. Some new categories of qualifying expenditure have been added for work carried out related to pure mathematics and cloud costs associated with a project. There are currently 2 schemes under which companies can claim R&D relief. The first is the SME scheme used by small and medium-sized enterprises, and the second is the RDEC scheme, mostly used by larger companies. Changes are being made to both schemes, making the RDEC scheme more generous and the SME scheme less so. The government's stated policy aim is to eventually align these 2 schemes to simplify matters, though whether this will actually happen is anyone's guess. Currently, SMEs receive 130% enhanced deduction on any qualifying R&D spend. This will be reduced to just 86%. In addition, loss-making companies can surrender the R&D tax credit to HMRC for a repayable tax credit, currently 14.5%, which will be reduced to just 10%. This will be a reduction of 44% on the tax saving to SME claims and will impact cash flows. Doom and gloom aside, although the benefit of the R&D is reduced, the relief is still very much worth having if you can have it. I've included some tables which shows the impact of the changes and the impact on cash flows for R&D companies. A new measure was announced in this week's budget. Loss-making SMEs with an R&D intensity of at least 40% will continue to be eligible for a 14.5% surrender instead of the reduced 10% from April 2023. What this means is that instead of the 18.6 pence for every pound of qualifying spend, these loss-making companies will receive 26.97 pence for every pound of qualifying spend, resulting in an additional 31% cash from HMRC for loss-making companies, most of whom will be at the early stage of development. We believe this change was made due to lobbying by agents and clients alike. The RDEC scheme is used by companies over a certain size, in addition to SMEs undertaking grant-funded R&D. There is better news for these companies as the RDEC rate will increase from 13% to 20% for qualifying R&D from April 2023. The RDEC itself is a taxable credit, so the real increase isn't quite as substantial as it sounds. The effective increase in the credit from 10.5 is 10.5% of £1 of qualifying R&D spend to 15 pence per pound of qualifying spend. The RDEC scheme remains less generous than the SME scheme, but the gap has narrowed considerably. So that's all from me for now. So over to our final poll question.
But thank you everyone for the questions you've been submitting as our speakers have been talking. They've been coming in thick and fast. Please do continue to submit them. You can see the instructions on screen now. And if we're not able to answer all the questions we received today, then one of our experts will follow up with you after the webinar to cover your query. So to the questions, I'll invite all the experts back on screen. The first one I've got, to some extent we covered within Dan's section, but it's a specific query around capital gains tax, Dan. Are there any changes to entrepreneurs relief? So this is the tax rate at which someone can get 10% capital gains tax rate, also now known as business asset disposal relief. And the specific query is, should we push a sale through before end of March 2023?
The simple answer is no, there weren't any changes to entrepreneurs relief, and I'm glad somebody else can't cope with the new business asset disposal relief title as well. So capital gains tax rates have stayed the same, 20% for 20% and 10% for normal sort of disposals, investment shares and things, and 28% and 18% for residential property. And those rates depend on whether you're a higher rate or a basic rate taxpayer. But no changes to entrepreneurs relief, so still 10% tax rate on qualifying disposals, up to a lifetime allowance of £1 million per individual. So so no changes and no need to try and rush through any disposals before the 5th of April.
Thank you very much, Dan. The next question I want to, I'll pass it to you, Sam. This has come in from Kerry. She asks, how are the proposals for capital expensing different from the capital allowances? If you could just expand on more of what you said on your slides.
No problem. So the full expensing relief is in fact a capital allowance. It's 100% first year allowance for new items of plant and machinery any business acquires. The relief allows the company some certainty as to tax treatment, so it does encourage businesses to spend on CapEx. But as mentioned, we feel this will only actually benefit a small number of companies due to the £1 million annual investment allowance.
Thank you, Sam. We do actually have a pension question, Kim, so I'll pass that to you. This is coming from Clive. Will the increase in the annual pension allowance also apply to those previous year's unused allowances that Dan referred to?
Thanks, Jen. Hi, Clive. So it won't. In a nutshell, it won't. So from the 6th of April 23, you can put 60,000 into your pension. What then happens with previous years, so you have to use your 60,000 for 23-24, and then you can carry forward from 2020-21, and that allowance there will still be at the 40,000. And those middle years, 21-22, 22-23, will also be at that 40,000 allowance. So that 60,000 is only moving forward.
Great, thank you. That's very clear, Kim. We haven't covered much on this topic, but I'll pass it to Dan. Obviously, we've seen there's going to be some changes in the childcare reforms. Not all of them come in immediately. I'm sure people are aware there are existingly some restrictions on the free childcare hours that people can benefit from in terms of income levels. The question that's come in, Dan, from Nick, is are there any restrictions on those who will benefit from the improved childcare reforms?
Thank you, Jen. So the current rules are that if either parent earns more than £100,000, then you can't qualify for the free childcare, and both parents must be working for at least 16 hours a week to qualify. And both of those conditions, those qualifying criteria, will apply to the new extended free childcare. So there are no changes in those conditions and restrictions that apply. I think, as you said, Jen, this is being phased in over the next 2 or 3 years. So I think it's September 2025 that they're aiming that this will be in place for. I think the key question is really whether the childcare providers will be able to have the staff and the capacity and all the rest of it to be able to deliver that the increased volume of childcare that the government are hoping for.
Yeah. Okay. Thank you, Dan. I'll pass the next question to you, Sam. This has come in from Ian. He was asking, was there anything in this budget for employers?
Thank you, Jen. There were no specific relief for employers. However, there were no significant changes either, which will allow businesses certainty and allow for business as usual. We've had many years of changes with furlough and trading conditions due to COVID, so this should provide some comfort to most. As Dan's mentioned, the proposed changes to free childcare should encourage more workers back to work without having to weigh up the cost benefit of paying for childcare over returning to work after having a family. You might see some changes there as an employer. There will be a couple of consultations going out around tax approved share schemes, which will simplify the admin around implementing these schemes. Share schemes are an effective way of incentivising and retaining key employees as an alternative to salary.
Thank you very much. Kim, I think we have to some extent covered this on our slides, but just worth repeating because they are such big changes. We've had a question in from Susan. Should I be paying into my pension again now for inheritance tax purposes?
Well, the answer is, quite frankly, it depends. If your driver is solely inheritance tax and you're not worried about any changes in future legislation, and you're not worried about tax-free cash or your tax-free cash being limited to that 268,000 figure, then yeah, the money is held inside a pension. It's free from inheritance tax. So it really depends on your circumstances, whether you've got any protection in place that might be revoked. But yeah, so it's sorry to be so vague, but I think the answer is it depends. Yeah.
Okay, thank you, Kim. And as you might expect, we've got plenty of questions coming in on the pensions front. So I've got another one here from Brian. Brian asks, how does the change in the lifetime allowance affect those who have obtained a certificate for fixed protection 2014 and added individual protection 2014? He goes on to ask, can they now make further contributions to their SIP, their self-invested personal pension?
Okay, so Brian, yeah, so you can have fixed protection and individual protection. So the differences between them is fixed protection means that you shouldn't be paying any more into your pension anymore, otherwise it will be revoked. Individual protection means you can keep on paying into your pension. You can have them both. So it depends what value your individual protection is. Fixed protection 2014, it fixes your pension savings, so free from free from lifetime allowance tax up to 1.5 million. So if your individual protection is above that 1.5 million, then you could carry on paying into it. So again, I sound vague, but it depends on your personal circumstances. If you don't mind losing your fixed protection because your individual protection is higher, then it's probably okay to carry on paying into your pension.
I think what we're taking from that is it's important to get some advice, Kim, because
absolutely, every individual is different, Jennifer. So yeah, that would be wise.
Okay, thank you. And I'm keeping with you, Kim, because we have another one. Is there any other changes around pension recycling payment concerns if you have taken up the 25% already out of your pension pot? That's coming from Mike.
So no, there weren't any changes to that announced. It's a funny rule. So what it means is that you can take your 25% out of your pension fund, but there are anti-recycling rules in place, which means that HMRC don't like you to then put it back into your pension and get that income tax relief. So it's been in place for many years. Our view is that it just means that it gives HMRC an excuse to kind of prod around and find out what's going on. So there weren't any changes to that. So I think, again, the message is do be careful. There are many questions. There's a set of sort of seven questions, and if you answer yes to any of those questions, then you have been deemed to recycle your tax-free cash. But yeah, again, I think the message is let's have a look at it and we can advise you properly, but there were no changes, to answer your question quickly.
Great, thank you, Kim. Hopefully that's gone some way to answering your question, Mike, but if you need any help, get in touch. Dan, I've got a question here from Ian. He says, I'm 74, sorry, I've aged you by a year, Ian. 74 and in full-time work. I have very few outgoings. I get a government pension and wages from my company. Can I top up my private pension and avoid paying tax?
The simple answer is yes, you can. You can continue to make personal pension contributions. There's something called a special annual allowance called the money purchase annual allowance. So if you've accessed your personal pension, that gives you a reduced annual allowance. So instead of the 60,000, that will be £10,000 from next year. It's £4,000 at the moment. But what you've said is that you're getting a state pension, but you haven't mentioned that you're drawing a personal pension, so that may not apply to you. As I said earlier, the key thing is to make sure you're not putting in more than your net relevant earnings, your employment income, and it depends on your level of income what tax relief you'll get as well. So you get basic rate tax relief at source, the 20%, and then you get higher or additional rate tax relief through your tax return. So yes, you can, but I think it's as most of the answers have been today, it's a question of looking at your personal circumstances and making sure that it's right for you. Kim, I don't know whether you've got anything that you'd like to add to that.
No, Dan, I think you've covered that very well. Thank you.
Thank you, Dan. Sam, we've got quite a specific one here that's come in from Helen. Has the Chancellor issued any guidelines as to what the interest rate will be on directors' loan accounts for the new financial year? So I guess this is when directors either lend money to or from the company.
Thank you, Jen. So the interest due on directors' loan accounts is actually based on HMRC's official rate of interest, which is currently 2%. This is due to increase to 2.25% from April 2023. There is always the caveat that the government can change this mid-year, so watch this space, but at the moment it's announced at 2.25%. It's not there to be too punitive. Where there are overdrawn loan accounts, there will be no change to the Section 455 charge, so 32.5%, as this is linked to the dividends tax rate as opposed to the corporation tax rate. Thank you.
Great, thank you, Sam. We've got a few more questions coming in. Dan, I've got one here that's coming from Mike. He says, I run my own company. Am I better off making personal pension contributions or company pension contributions?
Thank you. I think this is going to sound like a bit of a stuck record, but it depends, very much dependent on personal circumstances. So if you make personal pension contributions, you will get tax relief at your marginal rate of tax. So that might be 20, 40 or 45%. If it's through the company, then it could be 19 or 25% tax relief, or that marginal rate that Sam talked about earlier as well. It also depends whether, if you want to make a personal pension contribution, you need to take the money out of the company first and incur personal tax and potentially national insurance and things as well. So I think the general answer is, if you're a higher or additional rate taxpayer and you already have the cash available to make that contribution, probably doing it personally is better. If you're a basic rate taxpayer and the company's paying at those higher rates of tax than the company, and otherwise it really does need to look at the personal circumstances to see where you're best to do it. I think the other thing is just to come back to the point I made earlier about net relevant earnings. If you're taking most of your income from the company, perhaps as a small salary and then dividends, you may not be able to make personal pension contributions, or only up to the level of your salary. So there's more flexibility to pay up to that £60,000 threshold by making company contributions than personal contributions.
Thank you, Dan. And just sticking with sort of people maybe having dividends out of their own personal companies and pension contributions, we have a question in from Jeremy that says, as a dividend earner, can that income count towards the amount I can pay into my pension?
The simple answer is no. So as I say, you've got to have net relevant earnings to make pension contributions. So that's employment income, including benefits in kind and things, and self-employment income. So if you're a partner or a sole trader, it does not include dividend income. So if you only take £12,500 of salary to use your personal allowance, and then the rest as dividends, the maximum that you could personally contribute to your pension fund is that £12,500 figure. But the company could make pension contributions on your behalf. So there's that ability for employer contributions to be made over and above the level of your salary income.
Thank you, Dan. And just in case anyone is thinking of this question online, what about rental income? Does that count towards net relevant earnings?
No, it doesn't. So it's just employment and self-employment. So not investment income, whether that's interest, dividends, rental income and things like that. So it's purely employment and self-employment income.
Thank you very much. And we've got time before we sign off for probably one final question. Sam, this is coming. Will this budget attract or retain large corporate employers in the UK? I guess they're looking at whether it will incentivise business to stay in the UK or maybe bring some inward investment.
Yeah, so as mentioned, we do still have quite a low corporation tax rate when you compare it to other countries across Europe and across the globe. Even though the rate is increasing, we also have a really good treaty network. So I do think that the UK is still a good place to set up business. Businesses might choose to look at other jurisdictions if they're already actually have business in that place. But if you're actually doing business in the UK, it's still a good place to set up.
Okay, so still somewhere as a place for business to consider. Great.
Yeah, definitely.
Thank you very much. Well, thank you to our panelists for those really insightful answers. IT permitting, I hasten to add, there will be a short questionnaire that will pop up at the end of our session today. And as usual, we would be really grateful for your feedback on our budget webinar. That would be really appreciated. So that leads me to say that whether you're already a client working with us or not, or if there are any additional questions or matters that we can help you with, or you'd like to discuss further with our team, please leave a brief description on the pop-up survey at the end of the webinar and we will be in touch. We'd be delighted to hear from you. So that leads me to say thank you very much everyone for joining us. Enjoy the rest of your day and we shall see you soon.